Hi everybody and welcome along to the Mint Monthly Update. Today I have myself, David Fife, one of the portfolio managers, and John Middleton joining us to talk about the month of February that was. And it was an interesting month. It was certainly a busy one. For us, in terms of reporting, we had locally 30 companies of the 50 reporting, so it's quite a sizable reporting period. And of course, in Australia, we had a lot more as well. So it's been a very, very busy time for the team, but quite interesting at the same time. Now, just having a wee look at what drove the market, it was a little bit of a soft month for New Zealand. It certainly underperformed some of its peer markets. But what drove that? Where were the headlines? And I guess looking at the chart on the left, which shows sort of the breakdown of beats versus misses, there was certainly a lot more misses than beats in the New Zealand market. And I guess there was a few drivers of that. I guess the unsurprising one was certainly interest costs, and net debt numbers were certainly higher across the board, and there were certainly some upward revisions on a lot of those numbers. And that flew through to EPS outcomes. So I guess when you look at earnings and outcomes for the companies for this year, and even so, if you look at the bottom line in that chart, the FY25, certainly some soft outlook statements and some soft earnings expectations as analysts adjusted numbers downward. And I guess one of the key drivers was certainly the cyclical sectors. We've certainly heard a lot about Fletcher Building and then that name. That's been in a lot of pain, and that was part of the drivers. But we also had a few other names out there, which was from the retail sector, a few bits of pain there for sure, and also things with sort of economic activity exposure like Port of Tauranga. Even Freightways wasn't too bad, but again, it's not a great outcome short term, as we sort of look for the, dare I say, green shoots, which are still waiting to happen. But the interesting chart on the right there, I thought I'd point out too, is the NZX performance versus its global peers. Now, we know we're not a market full of data centers and AI stocks, but certainly the NZX with the more cyclical skew and our stage in the economy, we are a little bit ahead in terms of the downdraft. We'll see how the RBNZ decides to head with rates in the next while, but certainly, New Zealand has underperformed. So I'm not calling a pivot yet, but it certainly feels there's a lot priced in. And rolling over to the New Zealand SRI fund. For the New Zealand fund, it was a reasonably okay month. We had a few wins, a few misses. One of the interesting names was A2. That was certainly one of the outperformers in the NZX 50 for the results. Came in with a good result, I think, coming off its lows. We know there's been a lot of talk, and we've touched on it in the past, around birth rates being a big factor to the infant formula market. But a key piece here, and it's sort of shown in the chart below, is A2's market share. Now, while the purple line doesn't look massive, it is a big increase when you think about the size of the infant formula market in China. And so they've been executing well. You can't fault the management team for what they can control, and they've introduced a new China label product. And the transition's been almost flawless, you could say. So it's certainly done well through there. For us, it had been an underweight in the past. We'd actually reduced that coming into this result. But again, it's sort of moved a long way. And for us, we're sort of keeping an eye on what the medium term looks like for this company. We know them executing well right now, but we saw Feiha, one of the bigger competitors, recently say, volumes are off and things are challenging. So what's the competitive response going to be? We still think that there are some risks ahead, but we think in the near term it may continue to do well. Now, the other positives in the market were the gentailers. They the higher electricity prices, they did pretty well in terms of how they've charged in terms of pricing on their retail books, doing well there. But of course, cost inflation has been a constant, and so all the names there had a bit of creep through there. While we did see some upgrades in terms of Mercury and Contact in terms of guidance, cost creep is sort of something we're seeing across the board. And the last one, I spent last week actually over in Australia with Infratil. They hosted Investor Day there. It's one of our bigger positions. And they gave us a sort of 101 or a walk through the big names in their fund, which is 1NZ. And that mobile business is performing well, and that's certainly something we're keeping close on. And that's a name that we sort of think they can look to increase margins and maybe do a little better in terms of cash flow generation. But the key assets we were focused on was Longroad. That's the US renewable business looking to build a lot of solar farms in the US. And I think we came away with the view that the pipeline there is genuinely sizable, and their development capability is very credible. So we think that they can achieve their 1.5 gigawatts of solar a year. Now, there are some questions around Trump and the election, We think that they might be a little bit overblown, but there is some risk to that, but we don't think that changes the model. And the last but not least for Infratil was CDC, which is their data center build in Australia. I got the joy of seeing one of the competitors' sites over there as well. But in terms of CDC, their development pipeline is huge, and they gave some guide to FY26 about having up to 1 gigawatts of data center build underway by then. In terms of context, they're currently sitting in the mid 200s. So that's quite a sizable increase, with about another 200 or so underway now. So this is sort of a doubling and a doubling within the next few years. So we know there's a lot of data requirements out there, and they can't build them quick enough. So it's certainly a positive outlook, and for us, a name we continue to like and like the near term. And passing over to John for the Australian fund.
Thanks, Dave. Yeah, Australasian Equity Fund had a good month, actually. Good result, notwithstanding weaker Australasian markets, as Dave's alluded to. In terms of performance, again, it's that AI trend continuing. We talked about Megaport last time, but the theme there continued, and this month we got a very helpful contribution from XDC, which I'll talk about with the property sector. The thing I would talk about, Dave's talked about results, and for the most part they were good. I suppose the standout in the fund for last month was really CSL, and there were two sort of new bits of information. First of all, negative, we got an update on CSL 112, which is a development drug. The interesting thing there is it's basically a waste product. So they tried to see whether this plasma derivative would help stop the recurrence of heart attacks. Having had a heart attack, they spent about 3 to 4 years doing a trial, spent $1 billion, and unfortunately, at the end of it, there was no meaningful benefit. I think we do need to unpick that a little bit further, but ostensibly, it didn't do anything. So, not great news. And to be honest, that probably removed about $20 from our valuation, bringing it down from 350 to 330 on the blue sky, again, using something we currently throw away. But with that out of the way, we've got results. And I think, to be honest, we were pretty encouraged. We're involved in CSL because it's a, high quality, high growth business. And what we got from results was a, continuation of the view or of affirmation that that underlying plasma business, CSL Behring, continues to grow, very, very nicely currently, and probably that growth rate will improve going forward as collections continue to improve. Basically, COVID has disappeared, and the inverse is happening. We're getting a bit of a recession or slowing in the US, which is encouraging donations at the same time as we're rolling through a RECA product, a new means of extracting blood from patients or donors, which should materially improve yields. So again, it was a little bit weak in the month, but we've got further confirmation that this is a business that can grow double-digit over the medium term, and are quite happy sticking with it. Moving across to the property fund. Again, a very good month in what was a difficult month for the sector, as we alluded to again last month. Standout performance was that sort of data center story, which continued through directly NextDC and also Goodman Group talking up their portfolio of assets and essentially owning the land that they can convert into data centers going forward. So a very strong position to be in. But essentially we sort of got an update from NVIDIA which highlighted the fact that the chip side of things was improving, and when it came to NextDC results, they're not a management that hides their light under a bushel, but comments of we're on the cusp of the most significant change in digital infrastructure in my career was obviously taken positively by the market, and we do expect the consumption of data continue to grow through AI and other reasons over the medium term. So that was the main driver of the outperformance in the month. We also got a couple of interesting bits of news flow. So GMT Goodman Property Trust announced a couple of things. One, that they've internalised the management agreement buying the rights basically off Goodman Group, which cost them 272 million or roughly 12 times NPAT, which is not a cheap price to pay, but certainly gives them opportunities going forward. The other sort of clever thing that they did at the same time was basically announce a new fund, which is to develop more logistics assets in the Auckland area. And they're contributing 100 million of equity, and GMT, Goodman Group in Aussie, is actually going to contribute another couple of hundred as well. So, it gives them opportunities of growth going forward. And, more importantly, it probably removes the risk of any need to raise capital in the short term. So, pretty well received. The other bit of interesting news flow was relating to precincts, and not directly but indirectly. Essentially, ADIA, so the Abu Dhabi Investment Trust, which has had a stake for a number of years, sold that 15% holding into the market, which, at face value, neither here nor there. I mean, the interesting thing is that that's 260 million of equity placed overnight, in probably in the space of an hour. So, it reassures us that there is health in the property market and NZ markets in general. And also, the expectation going forward is we have reweighted precinct in most property funds on the back of the transaction. The free float goes up, and we would expect a follow-on of smaller property or index weights reweights up to benefit precinct over the medium term. Still like it as a quality play with prime office assets and the ability to grow medium term. But again, this was a nice little catalyst as well. With that, I'll say sort of thank you. We appreciate your support as ever. If you do have any questions, please drop us a line to info@mintasset.co.nz. But hope you're all well, and we look forward to speaking to you in a month's time. Thanks.